Holistiplan presents Tax Time with Jeff Levine. Let's talk taxes. Hi, I'm Roger from Holistiplan. I'm here with Jeff Levine. He is the Chief Planning Officer at Buckingham Strategic Wealth. He is also a member of our team here at Holistiplan as our tax planning strategist. Jeff, great to see you again. How's it going?
Good to be back with you, man.
Yeah, it's been a while. And I'm sitting in a torrential downpour. So if I seem distracted, it's because the heavens have opened up above me here in Texas. So apologies. So I was a little disappointed, Jeff, because I was hoping you and I would have an argument today. But it turns out, I think we agree on the point, although we'll see. But I do know this is something that other people will absolutely argue with us about. So we'll just put our opinions out there into the world and see where it lands. Does that sound good, Jeff? Stir things up a bit.
People are free to argue their cause, and maybe we'll change our mind. I don't think so, but yeah.
We might. All right. So first thing I have to do is share my screen here, which is not something we often do on this deal.
We've successfully teased this pretty well. What are we arguing about?
Well, let's set it up. So can you see my screen first of all?
I can. You're in good shape here, sir.
Okay. So let's set it up. So we have super simple, single filer, two sources of income. They have wages of $150,000, Social Security of $20,000. They put some money into a 401k, 15 grand. They have an above the line deduction, HSA. They have, they're going to itemize. They have $20,000 of charity. And so if we put that into our, if we put that into our scenario analysis, the total tax is $24,000. Okay. They're in the marginal bracket of 24%. And so often we talk about the margin. We make our decisions at the margin. If I can save or add $1,000 of income, that's where the impact is, 24 cents on the dollar, right?
The number we can control the most, correct?
Correct. But then there's this other question, which is, which of the following are the most, and I'm going to choose my words carefully, the most illuminating discussion with your client, the most illuminating percentage tax rate to discuss with your client beyond marginal rate? I think we all agree marginal rate from a planner's perspective is super valuable.
I was going to say, I think that it's worth actually pausing there for 30 seconds just to say that clearly there should be no discussion even. Like I will entertain arguments about which of the ones we're about to discuss is the most relevant. But when it comes to overall, if you could just tell me one rate that the client is paying as a planner, what do I care about most? It is unequivocally the marginal rate, because it's the thing that I can influence the most. And it's the thing that as I make decisions with the client, as you mentioned, add a little bit of income this year, take a little bit of income, bunch deductions this year, don't bunch deductions this year. It's the thing that I can control the most. So it is by far the most important rate for a planner. All right, now that I
got it. Okay. So that was 24% for this client.
Mm-hmm.
So calculation one is I'm going to take total tax, which was that $24,000 something, divided by taxable income. In this case, that is 19.15%.
So you've taken their, either in this case, the client's standard deduction or their itemized deductions, you back that off.
Everything. Well, I mean, everything, taxable income. So after all deductions, this is the 19.15%. It actually equates to what is the average of all the bands that they're paying on their taxable income. Okay. Calculation two is on Form 1040, we have the total income line. I guess I could have done taxes over AGI, but let's leave that one aside. We've got taxes over total income. So in that case, that is 16%. And so total income in this case is going to be wages after that 401k contribution. It's going to be Social Security after the portion that is not taxable. So 85% probably in this case. So that is 16%. We're dropping here. Calculation 3 is I add back that piece of the Social Security that was not taxable. So now it's 15.69% because our divisor has adjusted upwards. And then calculation 4 is my total tax divided by the total income before you take away any deductions, salary deferrals, anything. Like, what is the actual like income amount before doing anything? And that works out to just 14.3%. And so the range is marginal rate 24% all the way down to 14.3%, or whatever you want to call this thing, calculation 4, which is your total tax divided by total income before any adjustments, any deferrals, anything like that. So which of those 4, Jeff, would you argue, if you're sitting down with a client, they're like, just tell me how much I paid in tax as a percentage? Which one of those is the most illuminating or the most easy? I don't know. You come up with the best adjective, but which one is the best explanation to a client as to what's going on with their taxes?
Yeah, I mean, I think I'll call it the best rate of what they're paying. You know, their best average rate. Let's call it that. And I would say, for me, it's 3, hands down.
Interesting. Okay, so we do disagree. So you are going to say 3, which is before you worry about the 401k.
Correct.
Okay. Good. We do have an argument, Jeff.
All right, let's do it.
So,
gloves off.
So make the case for 3 versus 1, 2, or 4.
Well, I mean, let's go through each one. 1 to me is, you know, you're getting deductions, but you're spending those dollars. Those are real dollars that you have put in your pocket. If you're using it for interest rate, or you're simply getting a standard deduction, that's the easiest case right there, right? Like, you're not paying tax on that income. The standard deduction this year for a married couple is like $25,000 of free income. That counts. I mean, that is especially, you know, look, if you're making $3 or $4 million a year, it's not going to move your effective tax rate that much. But if you have $100,000 of income, I just removed a quarter of your income for you at no income tax whatsoever. That impacts your rate. So I think calculation 1, even though it's the calculation a lot of times that many CPAs will show on the return,
right? That's a great point.
It is not the best calculation. Calculation 2 for me gets a lot closer, but there is some tax efficiency there with Social Security that I'm losing out, which factors into calculation 3, which is the one that I chose here. And the reason I think that is impactful is because if I do something as a planner and I can make more of your Social Security tax-free, well, now I'm decreasing your tax rate. I need to show you, and I don't mean this as a justification for my own existence, but I mean literally just to explain to the client, like, hey, this actually does lower your taxes. We're getting you more. And if I use the calculation 2 above, I'm not able to do that, right? Like, anything I do to minimize your taxation of Social Security income is not reflective in our discussion. Now, I am a little bit torn here between 3 and 4. So I'm not dogmatic about it as I am not 1 and not 2. But here's the reason I will use 4. We'll avoid 4 is because ultimately everything in calculation 3 is done, has been taxed. I have paid that. And with calculation 4, if I include it here, right? If I include those W-2 wages here, what happens when I run the same calculation in 20 years when the client is taking that money out, right? Ultimately, for me, I can't count that income twice. That seems unfair. And so if I'm taking the income today and I'm using it, well, then when I actually take it later on in life and it does create income, I kind of have to not include it then, which seems at odds. So to me, it's really anything that I would start with all income and then subtract things for which I will pay income tax in the future. So you can argue about that on the margins. For instance, is an HSA deduction something that you would take off there because theoretically you might pay taxes in the future, I would generally take the argument it'll be tax-free, there'll be medical expenses, et cetera. So there are some on the margin examples here, but to me, ultimately, it's what income did I have today that is now free and clear? What pot of money have I moved into? I can then go spend whatever is left from this after paying the tax. And what was the rate I paid on that? Whereas for calculation 4, again, at some point in the future, I will have some 20,000 plus, or in this case, sorry, $15,000 of income that I have to pay income tax on.
All right, so I'll make the case for 4, but first I just want to highlight what you said about calculation 1. That is the one that when the tax preparer puts that cover page on the tax return and it says effective rate, that's the word they typically use, effective rate. That's the number that's on there.
Lies. They sit on a throne of lies.
And in my opinion, it's the least valuable number, but it's super easy to calculate, right?
Yes.
And the thing is, that's the thing people fight us on. And I can guarantee as the software, the person who's built some of the software, like that's the thing that people fight us on, because I'm trying to push people towards the other way. And people are just adamant, like, this does not match what the CPA gave. This is not useful. So anyway, calculation 1 is where we may get some pushback. So here's my argument on 4, which is, I think you make a good point about this is the amount that is free and clear of tax forever. And so therefore but I feel like that's still a very planner focused way of looking at the world. I think the client, when they're sitting at my desk, they just want to know, how much money did I make total? How much tax did I pay total? Divide one by the other. So to me, like, that's answering that question. And if you ignore the 401k piece, first of all, you're not answering that question. And second of all, I think you do yourself a disservice if you were the advisor who advocated for doing that 401k contribution. Because if I look at these last 2 values, I can sit with the client and be like, hey, look, your marginal rate, yes, is 24%. And that's where, if we're going to do new stuff, that's where it's going to be impacted. But even just my recommendation that you do that 401k contribution, I was able to drop your average rate. I don't know what the word to use is. I was able to drop your average rate from 15 down to 14% just by doing this. And yes, you're going to pay it later, but right now we were able to drop your rate by that amount. And I would argue, by the way, Jeff, that like that income will show up later. And so that would show up as part of the percentage later on, the average tax rate. So I don't know, man. I'm a huge fan of 4. The disclosure I have is that actually 4, we don't report out in Holistiplan because on the tax return, we don't know what was given to the 401k. I know everything else. I don't know what was put in the 401k. And in fact, I've been thinking about, like, maybe we need to ask for that. So advisors who want to show calculation 4 could at least enter that information and say, look, let's take it all the way down through. There's other reasons you might want the 401k contributions, but take it all the way through. Here's that blank rate, average rate, mega amazing average rate. I don't know the name of it. That's another thing that people argue with me about. But yeah, I'm an advocate of 4. So I'm glad that we had a way to disagree. And I see the arguments both ways. So I don't know. Let's see what people think.
I was going to say, let's see what people decide. Let's put up a poll. And yeah, what do you like? 1, 2, or at least comment. Let us know.
Yeah, I would really be interested in knowing, because we'll be able to, I mean, software is easy to program it up to do any one of the 4 or all 4 if advisors have a choice, either one. I think at present, the software will do calculation 1 or calculation 2. And it would be really easy for me to add 3. And in fact, I think I'll replace 2 with 3.
Yeah.
But there's more we can do there. So, well, that was fun, Jeff. I'm glad we got to disagree about stuff.
It's a good discussion. I mean, look, I think at the end of the day, there is an argument to be made for each of the 4. It's going to be really, really hard to convince me of those arguments on 1 and 2. I do understand where you're coming from 4. My only issue again is, like, what if in the future the client is at a 37% tax rate, right? If my if I'm showing like, look what I did, I brought you down to, to 14%, but at the end of the day, they're going to get clobbered in the future. I mean, it goes back to Roth or not discussion, but I would argue, I guess, that if you have the 401k and you've put that aside, you're effectively saying you haven't earned that income this year, right? In fact, even in the sense of, if we go to take it all the way out to death, right? And someone inherits that income, there's no step up in basis, because the income is literally considered to be IRD, income in respect of a decedent, something that someone earned during life, but hadn't really paid tax on yet. And so, for me, that's where it comes in. But I do totally understand the argument to four of everything you made this year, what was your effective tax rate? I just have a hard time reconciling, if I include it here, am I double counting it when I include it again in the future, when it absolutely will be part of that calculation? We would all agree.
Yeah. All right. You get the last word, Jeff. You've earned it.
All right. Well, it doesn't happen in my household, so I appreciate that you let me have it here.
All right, brother. This was fun. Thank you.
Good deal, Roger.